What is up, you guys? Michael Elefante here. I apologize for those who are subscribed. I've been gone somewhat nomad over the past few weeks. Last week, my wife and I spent some time on a lake celebrating our 1-year wedding anniversary. And the week before that, we were super busy evaluating a new investment, which I'm going to talk about with you guys today. And I was driving around like crazy and also preparing for our vacation and preparing my day job for the time I'll be spent off, just preparing some things while I'm out of the office. So before we get started on this, I do appreciate you guys. If you will, please hit the like button and subscribe below. Now, many of you may have clicked on this video because you're curious how I plan to achieve a 75% total return on investment in just the first year alone, and also earn over $75,000 per year, growing each year in the future in profit. That's net profit. Now, before we begin, I definitely want to state that this isn't just me. So when I say I'm referring to both my wife and myself, because without combining our incomes and our savings and being on the same page as far as our goals, this investment nor any of our other investments wouldn't be possible. So let's dive right in. So again, this is going to explain how I plan to achieve a 75% return on investment in the first year and earn over $75,000 per year in net profit. And this is with an Airbnb investment. So here's a little bit of details around the investment. The location, and this is a big thing for me right now during the COVID-19 or coronavirus pandemic. With all the shutdowns, we've seen some crazy fluctuations in Nashville and other large cities that typically experience great tourism. It's fluctuated like crazy. Our prices have fluctuated, our occupancy has fluctuated. But what's interesting to me is I've talked to several friends and other investors, realtors, and other folks that are involved in the Airbnb industry, and the mountains, the lakes, the beach houses, they're exploding right now because everybody that was planning a different vacation, whether it be internationally or maybe they were planning on hopping on a plane and going to a city they've never been to before, they're resulting to somewhere they can drive and be a little more secluded. So the Smoky Mountains, which already has around 15 million visitors a year, the number one highest visited or the most visited park out of all the national parks in the United States, actually right now are seeing an even higher percent occupancy than they normally do, which is wild because they already have a pretty high occupancy as it compares to other locations around the globe. So the location is in Gatlinburg, or in the county of Sevierville. The house in itself, I've been looking at houses in this area for about a year now, and I've been waiting for the right opportunity to come up. So this house is a 4-bedroom. It has 3 full baths, 2 half baths, and is around 2,900 square feet. It is currently listed as a short-term rental. They only list on VRBO, and it's currently generating a little over $60,000 a year in revenue. I think this year will be a bit higher than that, just based on the influx in people looking to invest or go on vacation out there. It currently is only listed to sleep 12 guests, which you're going to learn with me. It's really important to maximize the number of guests that you can sleep comfortably. Will maximize the amount of money you could make on a nightly rate and will increase your occupancy over time. Their listing price, or the asking price from the seller, was $550,000. Now let's break down the investment numbers. So when I was initially communicating with the realtor and our loan officer, I was working on reducing the amount of money we spend out of pocket. And a large chunk of that is not just for the down payment, but also for your closing costs. And if it's an investment loan, you know, it's even going to be higher in closing costs, but we were able to achieve a secondary home loan, which I'll touch on in a minute. But what we wanted to do is work on a lower offering price and then negotiate back up to around the asking price, but have the seller pay for the majority of our closing costs. Because again, if we're paying 3% on the total house price for closing costs, that's going to be around $15,000 here. If we can get the seller to pay for the majority of that, we'll have more money to upgrade the property and also be less money out of pocket up front. So the total return on our investment, which we'll go over later, is going to be higher. So that's very, very important. So our initial offer was $535. They countered immediately with $542. And what that told me is the property's been sitting there for a little bit, and because it needs some cosmetic upgrades, they were willing to already dip down in price. And this is a hot market out in the Smoky Mountains in Tennessee. So our final offer, which was accepted pretty quickly, was $550,000, which was the seller's asking price. But we asked the seller to contribute $10,000 to our closing costs and pay for our title. And the title's around $2,000 or $2,500. I have to go back and look at the loan disclosure. So that totals about $12,000 of a burden off our plate that the seller's now going to pick up. Now, why this doesn't matter to the seller? Essentially, the seller is going to be taking whatever proceeds are left over after the deal, after they pay whatever loan they have left and pay the seller and buyer's agents and other seller closing costs. So if they're totaling about $12,000 in our closing costs, that's essentially like offering $538,000 with no closing costs contributed to us. So to them, it makes no difference, but to us, it makes a huge difference. And the loan, this is very important for those watching. So a lot of people think you have to put 20 to 25% down, which ordinarily you probably would have to do as an investment property. But since this property is located, much further than 100 miles away from our house, and we're also going to use it at our leisure as our own vacation home, we got a secondary home loan, and you can get one of these, per person or per couple, and we can put as little as 10% down. And what's cool about this is that we locked in a 2.875 rate, which is incredible. Rates are at all-time lows right now. We would probably have gotten a 4 or 4.5% rate if it was an investment property loan, because the bank is looking at it as a more risky loan to us as the buyer. So why is this important? Much less money out of pocket from us up front. Again, because our closing costs are now going to be paid for majorly by the seller. And we're going to achieve a higher overall cash-on-cash return and total return on our investment due to this. And also the secondary home loan, we have a much lower interest rate, and we're leveraging more of the bank's money. Again, less money out of pocket because there's half the amount we would normally have to put down, 10% versus 20%. And our much lower mortgage payments, because when you shave off a point or a point and a half off your interest rate, the overall amount that's going to be paid to the bank over time is going to be less, and also your monthly payments are going to be less. So to sum this up, let's look at our total investment costs out of pocket. And again, guys, this is one specific investment. Every investment is going to be different for every investor or group of investors. So again, while this one is $550,000 cost for the house, there's other people investing in $2 million homes. There's other people investing in $100,000 homes. It doesn't matter. What we're going to focus on is the return on each dollar spent up front in the investment. So the total down payment was 10% of $550,000. So that's $55,000. Closing costs paid by the buyer, which is us, is estimated to be around $1,500. And I'm including the appraisal and the inspection fee and some other closing costs that will be in there as well. And the rest of the closing costs are going to be paid by the seller. Now that we are budgeting for some cosmetic rehab, and there's really nothing structural we have to do. What we'd like to do is rip out some of the carpet upstairs and put in a different flooring instead of carpet, because carpet will just get gross over time, and paint the cabinets, paint the walls, add some new furnish the house a little different, add some new furniture, and add some touches that will kind of make the place jump out, and then take professional photos, which will be drastically important to get guests' attention and get them ultimately to book our place more often. And right now we're budgeting for $45,000 in new furnishing costs and cosmetic rehabs. Again, I think we could probably do it around $35,000, but this investment and these numbers are based on that much higher, again, conservatively, for $45,000 out of pocket. So how much are we planning to invest out of pocket? So it's the $55,000 in down payment, $1,500 in closing costs, and $45,000 in furnishing or cosmetic rehab, and that totals to $101,500 out of pocket as an investment. Again, it's not just money that we've spent. This money is now sunk into this house, minus the closing costs. Here's the benefit. After our cosmetic upgrades and furnishing, we are now going to be able to sleep up to 17 guests. So we're going to take one of the king beds out of the rooms, and we're going to add 2 queen over queen bunk beds. And we also have a pull-out couch and a futon, so we have tons of sleeping room. We could probably sleep 18 to 20 guests, but conservatively we're going to aim for 17 guests. And by doing this, we're able to drastically reduce the cost per head or per guest that is staying at the house. So if there's a group of 16, they're going to get a better bang for their buck, and we can also increase prices because people are willing to pay a little more if they have more guests staying there. We're going to pay for professional photos, because right now the photos on the listing aren't that great. The lighting is poor, and the first photo honestly is through some trees and you can barely see the house. So it doesn't grab someone's attention. It doesn't make me want to click. And that first click you're going to weed out half the people that could potentially book your house if they don't even click on the image and want to see more. So again, we want more clicks, more views, and ultimately more bookings. So the end result from all of this is a higher occupancy and a higher nightly rate. So that's going to be a big increase in revenue and ultimately cash flow, and a big increase in our cash on cash and total return on investment. Now, first we need to calculate our cash flow. Before we calculate our cash on cash return and total return on investment, what is our cash flow? So this is big for real estate investors, for rental property investors. Our cash flow is ultimately what is going to help us achieve financial freedom. How much money can we earn per month in cash being deposited in our bank account? So our forecasted revenue is the first piece that we need to capture here. So the average daily rate multiplied by the total nights occupied. So I've been on sites like Airdna. I've spoken with a friend who's invested in Brevard, North Carolina, and he's helped me evaluate kind of what we think we can charge per night, and we can kind of look at the average occupancy for the area, again, through Airdna and networking with people who have investments out there. And this is a conservative investment. For a 4-bedroom property that sleeps 16 plus people in Gatlinburg, those properties are going to see $90,000 to $110,000 a year in revenue. So conservatively, I'm going to go on the lower end of that with $400 on average nightly rate and 225 nights a year booked. That equates to $90,000 a year in revenue, or divided by 12 is $7,500 a month. Now, that's not $7,500 a month in cash flow. Again, we have to include our debt service, our mortgage, our taxes, and then our estimated, variable expenses, furnishing costs, repairs, maintenance, things like that, things we have to prepare for the future. So our estimated mortgage, and this is after we got the rate from the lender. They gave us our estimated mortgage. We got our short-term rental insurance, which again, I recommend doing specific to short-term rentals if you plan to do this, because it covers your butt a lot more than just a typical home insurance plan would. That estimates to be $2,375 a month. And then our variable expenses is $1,062 a month. Again, that's probably conservative. Most months it'll probably be closer to $600 to $700 a month. But if we have to make a big upgrade, or if we have to replace a washer or a dryer or something, it will be higher for that month. So I typically go for just a little bit higher on the monthly average. So the total expenses we're expecting, you just add those two numbers up, $3,437 a month in total expenses. So how do we get our monthly net cash flow? Again, this is pre-tax cash flow for the year. So our monthly cash flow is we're just going to do a simple math. Take $7,500 in revenue per month minus the total expenses per month. And that brings us to $4,063 a month in our pocket in cash flow. I think the majority of people could probably live off that just on monthly income from one property. This is why real estate is so powerful, and why investing in short-term rentals is extremely powerful. And that equates to $48,760 a year in cash flow. Now, what's cool about that, you could look at that number and say, wow, that's great. And then it depends on the return on your investment. So we need to calculate our cash on cash return. And this is basically equivalent to, hey, I invested in Apple stock, and after 1 year, it generated me, $15 per $100 invested, which would be a 15% return on our investment, right? So what's cool about this is money being deposited in our pocket in cash. So this doesn't account for appreciation and principal from the loan pay down, which we'll go over in total return on investment. So how to calculate cash on cash return? It is quite simply taking the total revenue minus your expenses and debt service or mortgage expenses divided by the total money we invested up front. So in other words, net profit before tax is divided by total dollars invested up front. So as you recall, our net cash flow for the year is $48,760, and we'll divide that by $101,500 of dollars invested out of pocket, and that gets 48.04% cash on cash return. And guys, that destroys any rate I'm seeing on a 401k, on an IRA. The stock market right now is pretty wild. So, if you could take the right pick and invest in Apple a year ago or Tesla, then you'll see some crazy returns. But overall, most people in the stock market, through longevity, are hoping for a 10 to 12% return on their investment. So 48% just cash on cash return, and $48,000 a year in net cash flow. Now, this is where it gets really exciting. We're going to calculate our total return on investment. and our total dollars earned each year. And this is conservative based on the appreciation we're accounting for. And what's cool about this is it will increase each year. And I'll explain here in 1 second. So the total return on investment, we're going to account for our net profit or net cash flow plus principal pay down plus appreciation divided by the total dollars invested out of pocket. So again, we already explained how to calculate the annual cash flow. That was $48,760. Now what's interesting about principal pay down, if you guys are or maybe aren't familiar with how a loan works from the bank or any type of loan for that matter, you look at an amortization schedule. So if you're looking at a 30-year fixed, each month you're paying your debt service, so whatever your interest rate was as to the amount of money you're borrowing from the bank, and then whatever's left over from that is actually going toward principal. So each month your debt service decreases and the amount you pay in interest decreases, therefore the amount you pay in principal creeps up. And this also works out in the bank's favor because they're collecting on their investment in you or their loan to you more in the early months. So if you pay off your house early, they're collecting more of their money up front. So each month up until the last day of the 30 years of your loan, you are paying some amount in interest and some amount in principal. And each month leading up from the day one to the last day, you are paying less and less in interest over time, but again, the most in interest up front and the least amount of principal up front. And over time, you're going to pay each month a little bit more in principal. So that's what's cool about this is the renters are paying down the loan for you. And that's a pretty good deal, right? So for the first 12 months of this house, I looked at amortization schedule, and the total amount for the first 12 months in just principal was $10,542. So that's equity in the house, again, that the renters are paying for us. And appreciation, again, conservatively, this area has been exploding. It's probably closer to 5 to 8% annually right now. And again, appreciation for me is just icing on the cake because this can fluctuate over time. There was a housing market crash in 2008, 2009. I don't know if that'll ever happen again. I'm sure it will fluctuate over time again. But even in Nashville, we're seeing a much higher than 3%. But this is how I account for in our return on investment. So 3% of $550,000 is $16,500. So it's probably going to be even higher than this because after we do some cosmetic repairs and refurnish it and have a higher rental income history, the resale value of the house 1 year from now is probably going to be drastically higher than that. I see no reason why after all that, and then if we achieve $90,000 to $100,000 in revenue, then there's no reason we couldn't sell this to another investor for $600,000 to $650,000 1 year from now. But again, conservatively 3%. So our total return on investment, this is where it gets really exciting. You take the $48,760 in cash flow, you add the principal pay down, $10,542, and then you add the appreciation at 3%, which is $16,500. That totals $75,802 that we have earned in just year one on this investment. Now, what's the total return on investment on this? So again, we just simply take that number, $75,802, divided by the total dollars invested up front of $101,500, and that brings us to just shy of 75% total return on investment. Now, again, that number is crazy, and it's going to go up each year because 3% of 550 is going to be, it's going to grow because the next year, again, it's going to be worth, you just add the 16,500 to 550, and 3% of the higher number is going to be more and more. And again, the principal pay down is going to creep up the next year, and it'll be more. And then if you have good rental history and you get more bookings and continue to increase the rate over time, then you're going to be able to charge more and be booked out more, so your cash flow could even increase. So this number could even go higher, which is wild. We're almost recouping 100% of our money. We're recouping 75% of our investment in the first year. So by midway through the second year, we would have already recouped all of our money, and it's just pure profit from then on out. And again, all that money is just going to be deposited into the rental property and into the piece of real estate that you own. And again, once that loan is paid off, 30 years from now, or maybe less if you want to pay it off earlier, that house is probably going to be worth, $1.5 to $2 million in 30 years. So that's a pretty awesome investment as far as comparing to a 401k when you can invest in a rental property that's producing you monthly cash flow and is going to grow exponentially over time. So again, through one property, you could have $1.5 or $2 million as a nest egg in the future that will continue to produce for you. And once the house is paid off, your monthly cash flow, your net cash flow is going to drastically increase because again, we take away that debt service because we no longer owe money to the bank. So that's it, guys. That's how we are evaluated this property. We're currently under contract, plan to close September 14th. I will provide updates along the way, and I would like to show photos or maybe a video walkthrough of before and after. And then in months from now, we could talk about how it's performing and see if it's up to our expectations or maybe below expectations and hopefully above our expectations. But if you enjoyed this video, guys, please do subscribe below. Please hit the like button. If you have questions, please comment below. Send me a message through Facebook, Instagram, through YouTube. I'm more than happy to talk with you guys. I've spoken with so many people over the past couple months that I've met through the YouTube channel, through LinkedIn, through Facebook, Instagram, all these different avenues, through networking with friends. And now I'm just talking with a ton of people through a Slack channel and helping them out with their investments. I'm learning a ton from other people through their investments. And that's what's cool about the real estate investing community is the more people you know, the more people you want to help, and the more people you help, the more people help you. So there's plenty of business to go around for all of us. Again, the goal is financial freedom, and I'm hoping that I can help you guys achieve that someday as well. But that's all for now. We'll catch you guys next time.